Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'm a staff member here at the OIC. I'll be guiding you through today's session, The Poor Man's Covered Call. In today's webinar, presented by OIC's own Mark Benzequin, we'll be going beyond the traditional covered call to what's known as the Poor Man's Covered Call, an alternative strategy for investors to potentially generate income with stock replacement. I'm pleased to introduce Mark, who is a Senior Investor Services Specialist for the OCC. He is responsible for providing support to a comprehensive options resource center that provides information education about options and supports all products traded on all OCC participant exchanges. Mark began his career in options with Stafford Trading before transitioning to brokerage operations. But Mark spent most of his career in the trading pit, gaining special insight into customer order flow and trade execution.
Hi, Alex. Thank you for that introduction. And ladies and gentlemen, thanks for joining us today. Welcome to another OIC webinar. You know, we love doing these presentations for you. I especially love doing these presentations for you, as I really enjoy speaking with investors and advisors about all things options. And today we've got something a little bit different for you. Everybody knows about the covered call, right? It's pretty much a basic option strategy that most investors are familiar with. It's one of the most popular strategies out there, but we're going to put a little bit of a twist on it. You know, regardless of what you think of the current climate in the U.S. in terms of our economy, our government, et cetera, you know, the one thing that we can't disagree on really is the stock market. The market's been a slow climb, a slow churn uphill for the last decade plus, periods of low volatility, and the covered call is really a strategy that people have been utilizing for the past decade plus that has paid off very well. Now, what that also means is that the market's getting kind of expensive. Some of these options we have, for example, or some of these stocks, I should say, you know, one of our favorite online retailers that, you know, sells books and pretty much everything else under the sun is trading for about $2,000 a share now. So to put on a covered call where we have to buy 100 shares of that stock, that's going to be a $200,000 investment up front. I don't know about you, but, you know, I certainly don't have that money laying around to put on that strategy. So, you know, we're often looking for something else to do, and that's where we come up with alternatives such as the poor man's covered call. So, you know, we're going to get into that in a little bit after we look at some things. Initially, first and foremost, we need to satisfy some legal requirements here. So our disclaimer, options involve risks and are not suitable for everybody. You should be familiar with the characteristics and risks of standardized options. And as a matter of fact, you know, I know that this booklet is a lot like some of those user agreements that you get when you download a new app. You really don't look at it. You just click agree and move on. But I can't tell you how many times this week alone I've spoken with investors that have had questions specifically addressed and spelled out in that characteristics and risks booklet, or the options disclosure document as we call it. So if you're not familiar with it, definitely something that you should be. You can get a free copy by contacting your broker or contact us at OIC. Also, to keep things simple today, we're not going to be discussing the commissions and fees, things like that. Definitely will impact your account, so keep those in mind. And then lastly, the strategies that we're discussing are simply for illustrative purposes and not used to be a recommendation or solicitation. Now, for those of you that are joining us for the first time, and I see that there are a large number of you, so welcome to OIC. Very glad that you found us. Very quickly, OIC is a free and unbiased professional options education organization. We are a not-for-profit. All of our resources completely free of charge. We do that mostly through our website, optionseducation.org, where we have online courses, videos, the webinar, for example. And with our pride and joy, the Investor Services Desk. You can get live options help by contacting us at options@theocc.com. We support all types of options. You can see the volume here that has increased exponentially over the years, especially over the this recent century from 2000 on, and that's primarily, we feel, through ETFs, electronic trading, and hopefully education. The more you know, the more you're willing to trade, and that's what we're here for, the responsible use of options. We support these exchanges, the CBOE, NASDAQ, the Boston Exchange, Miami, and the NYSE. They are the main exchanges in the country, and they own the 15 different exchanges under their umbrella. So that being said, let's go ahead and get right to it. Now, our outline, we're going to talk about covered calls. We're going to start out from the ground up. And as I had mentioned, this is going to be an intermediate level presentation. So even though we're going to be building the poor man's covered call by looking at the individual parts first, we're going to be looking at those fairly quickly in kind of a high-level overview. We're expecting that the investors already know some of this information. If you don't already know this information, quite all right. This hopefully won't be too far over your head. The presentation are all recorded and available for playback, so you can definitely get back into it and listen to it again, try to get a better grasp, and also obviously take a look at our website, optionseducation.org. So we're going to start out with covered calls, a brief overview, then we're going to get into ellipse options, what they are. We're going to look at diagonal spreads, because what a poor man covered call is basically a diagonal spread, or a time spread as people call them, diagonal spread using leaps. And so we're going to put everything together into the poor man's covered call, or as we also call it, the thinking man's covered call, simply because it can be looked at as a better use of our capital. And then we've designed the presentation to have plenty of time for Q&A. So let's go ahead and get into it with a basic overview of covered calls. For those that aren't familiar, a covered call is basically where an investor simultaneously sells an options contract, a call contract, and they buy an equal number of shares, one short call for each 100 shares. Now, you don't have to buy the shares at the time that you sell the call. It's a strategy that you can use if you already have those shares in your account. A lot of retirees or older individuals that have amassed a portfolio of stock over the years, this is a way to put that stock to work for you, because what we're looking to do is increase our returns. We're looking to generate additional income for that stock. If the stock doesn't go anywhere, let's say we own 100 shares of stock trading $50, 6 months down the road, the stock doesn't really do anything. It kind of is relatively flat and relatively range bound. Maybe it goes up to 50 and a quarter. Maybe it goes up to 50 and a half, but certainly nothing to write home about. So you've made a little bit of money theoretically. You made a paper profit on those shares as they've marginally increased in value, but that's about it. Now, with the covered call is we're going to generate additional income over and above that marginal increase. So that's the whole point of the option, is we're looking to increase our returns. Our forecast with the covered call is neutral to bullish, neutral to moderately bullish, I should say. We're looking for a small price range or a range-bound trading within the lifetime of that option. If we think the stock is going to go through the roof and take off, well, this isn't going to be a trade that we want to be making. And we'll get into the reasons why in just a moment. But again, neutral to moderately bullish is our forecast. And just to digress for a second, I did a presentation the other day for another firm, and we were talking about strategy selection. Strategy selection, when you're placing a trade, begins with two things. What is your motivation and what is your outlook? Why are you doing the trade? Are you looking to do it to generate income, to protect your portfolio? Are you looking to acquire stock? What is the reason? What's the carrot that's ahead of us, that's dangling in front of us, that is causing us to do a trade? Number one. Number two is our forecast. What do we think is going to happen? Is the stock going to go up? Is it going to go down? Is it going to remain the same? What do we think is going to happen with volatility, implied volatility, I should say? And for those that aren't familiar, implied volatility is our future forecast, or the market's future forecast to where that stock may be based on the option price. And again, implied volatility, we're not going to get into that very much for this presentation, but there's a wealth of information at our website to kind of brush up on that. But our forecast, what do we think is going to happen to the stock? What do we think is going to happen to applied volatility? And when is it going to get there? Those are the key components. What's going to happen and how long is it going to take? So our motivation and our forecast. For the covered call, our motivation, increase returns. Our forecast, we're neutral to moderately bullish over a specific period of time. So we're selling options, right? That's what a covered call is. We are selling a call against stock that we own. Anytime we sell an option, we've got an obligation. The owner of the option, the buyer of the option, is in the driver's seat. He or she decides what they want to do. They decide if they want to exercise the contract for any reason at any time, assuming that we're talking about American-style options. It's a question that I had just the other day. Somebody was assigned early, I should say, on an out-of-the-money option, and they were incredulous. They couldn't believe it. And the point being is that when you sell options, especially American-style options, equities, ETFs, you can be assigned at any time. You have the obligation. You are accepting the obligation to sell stock at the strike price if you get assigned. In the case of a covered call, assignment isn't necessarily a bad thing. And we'll get into why in just a second, but the idea with a covered call is you're selling an out-of-the-money call, and if you get assigned, that means that the stock price went up to your strike, so you made money on the stock, you made money on selling the option, right? That was the whole idea behind putting the position on. We want to increase returns over and above that of our share price. So in this particular case, our obligation, that assignment, isn't necessarily a bad thing. So it's not something that is going to worry us too much. Now, in return for that obligation, we get the premium. So when we sell the option, that premium that we keep, that is the money that we make. That is going to be included in our overall profit. And speaking of profit, that's the thing with the covered call. We had said that if you're extraordinarily bullish on a particular stock, this isn't going to be the strategy for you. And the reason being is our profit potential is limited. If our stock gets assigned, if our call, I should say, gets assigned, we're going to have to sell stock at the strike price. So our profit is going to be limited to what we paid for the stock versus where we sell it, which is the strike price, plus any premium that we receive up front. So that is going to be the maximum that we can make on this trade. Doesn't matter if the stock goes from 50 to 55 and then on to 100, right? We were obligated to sell shares at that strike price. So our upward profit is going to be limited on that, something to keep in mind. Our break-even point, something that to me is very, very important. The break-even point is simply where do we begin to make money and where do we begin to lose money. So when it comes to the covered call, our break-even point is simply the share price minus the premium we received. We'll look at that graphically in just a minute to hopefully make it a little bit more clear to you. And then lastly, the downside, right, our loss. You can't look at the good without the bad. Every time we have reward, we've got to have risk. Whenever there's profit, there's a potential for loss. And in this case, with the covered call, that loss potential is substantial. The reason being is because we're short in option, but that isn't where our risk comes from. The risk comes from our long stock position. If stock goes down, that short call that we have is going to expire worthless, and that isn't going to be any risk. That's nothing to be concerned with. What we do need to be concerned with is that we're still long stock. If we've got stock from $50, what's the worst that can happen? The worst that can happen is that stock goes to zero, and that's the risk here. The risk is that the stock does have the potential to go down to zero. Now, that doesn't make this any riskier than just owning stock outright, right? Because you still have that same risk of the stock going to zero, whether you own those shares with a call against it or if you just own those shares by themselves. But like I said, that downside is substantial in that your risk is with the long stock. Now, let's go ahead and look at an example here of the covered call. If you are a numbers person, then this is going to be for you. We are long 100 shares of stock for 52, again, our forecast and our motivation. Our forecast is that we're neutral to moderately bullish over the next couple months. Our motivation is that we want to generate income, and we've got a target sale price for the stock. So here we go. We are going to sell an out-of-the-money call. Stock's trading 52. We're going to sell an out-of-the-money call at 55, for which we're going to collect $1.75 or $175. Now, you can see by the chart here, if stock doesn't move, $52 is where it closes at expiration. How much do we make on the stock? Well, zero. The stock doesn't move. We don't make anything on it. Our short call that we sold for $1.75, that 55 call, that's going to expire without value. We sold it at $1.75. It closes worth zero. Well, we've got $1.75 profit, so that goes in our pocket. If shares go up to, say, 55, we're going to make a few dollars on the stock. We bought it at 52. It's now trading 55. We're going to add the premium that we received when we sold those shares along to it, and we get a net profit there of $4.75. Now, anything over and above our strike price, it doesn't matter if stock goes to 55 and a quarter or if it goes to $500, anything over and above that strike price, we are going to be maxed out at our maximum profit. So our maximum profit is going to be $4.75. You can see if shares go to 60, well, we bought the stock for 52, so we made $8 on the stock, but we're actually losing money on that option. The option is now worth $5. We sold it at $1.75, so we're actually 3 1/4 in the hole. When we take our stock profit and we subtract our loss on the option, you can see there our net profit, our maximum profit remains $4.75. And you can keep doing that up until infinity. It doesn't matter where the shares go, that's going to be our maximum profit, $4.75. On the downside, take a look at $40. If the stock goes against us, trading $40 now at the close, we're going to lose $12 on those shares. However, that loss is going to be mitigated somewhat by that short call that we sold that expires worthless for $1.75, and that reduces our $12 loss, reduces it down to 10 1/4 per option contract. And that's going to keep going. We're going to keep losing on that stock, but at least that loss is somewhat mitigated. For those of you that would prefer a graphic representation of what we're talking about, and again, for those that are new, a graphic, charting out your P&L, graphing your P&L is an art that traders use, floor traders use on a daily basis. They like to see what their profit and loss graph is going to look like. Where do they begin to make money? Where do they begin to lose money? What happens when shares finish at X amount of dollars? What does that P&L chart look like? So it's definitely something that I recommend that you get used to and that you practice. It's not very hard to do, to graph it out, and it's going to pay dividends, no pun intended. It's going to pay dividends down the road. So here's the graphic representation. Stock finishes above 55. We know those shares get called away, so we're not going to make any more money beyond our price that we paid for the stock versus where we sold it and the premium that we received. So that's going to be our maximum $4.75 profit. If shares finish below our strike price, we are going to earn less money down to our break-even point of 50 1/4. So anything above 50 1/4, we make money. Anything below 50 1/4, that's where we begin to lose. So that is what we have for the covered call. Now, again, I apologize. I kind of went through it fairly quickly. Hopefully not too quickly. Hopefully a lot of this is familiar with a lot of you. For those that aren't familiar with covered calls, we've got a wealth of information on our website. Our YouTube channel has previous webinars about covered calls, so definitely take a look at that, and obviously contact our investor services desk with questions. Now, leaps. Let's go ahead and get into leaps. And leaps are timely. It's a very timely topic right now. The reason being is that leaps are what we call long-term equity anticipation securities. Leaps is not it's not plural. That S actually stands for something. And the reason I say it's timely is because leaps were just added about a week ago, a week and a half ago. Leaps were added for 2021. So we now have these January 2021 contracts available that are over 700 days away to expiration. So a Reader's Digest explanation or a summation of what a LEAP is, it's simply an option contract where there's more than 9 months until expiration. Right now we've got January 2020 and 2021 LEAPs in the books, and as you can see here, these new 2021s were just listed. Now, you can use the LEAPs with any type of strategy. There's no restrictions with that. In terms of what you can do with them. However, there's restrictions in terms of which stocks get them and why. Some of the requirements of LEAPs is that they have a 3-month average daily volume of 1,000 or more in terms of the option contracts. They need to trade at least 1,000 option contracts a day for a 3-month average. And when we talk about this, one of the important things to realize is that, number one, it's not guaranteed, meaning you're qualified for LEAPs for 2020, but let's say throughout the year as it goes on, there's less volume trading in that particular security. Now they are not going to be adding 2021 LEAPs. So just because you have them this year or because you had them last year doesn't mean you're going to get them again. And some stocks, when it comes to LEAPs, they have less strikes. The exchanges are the ones that make the decision as to which stocks to list options upon, which strikes to offer, which strike intervals to offer, meaning $1 increments, $2.50 increments, $10 increments, what have you, as well as which expiries to offer. Typically, you've got your 2 front months as well as 2 quarterly months. That's the basics. Anything over and above that, the exchange decides. So the exchange decides based on their policies and their criteria and their guidelines which options will have LEAPs listed and which strikes will be added. Typically, when it comes to a LEAP, they're only going to add a select number of strikes as opposed to every dollar or every 50 cents. They would probably go every $5 or every $10, something like that, depending on the share price. Why do we use LEAPs? Well, the saying "time is money" is never more apparent than it is in options. Meaning that the further you go out, the further something's going to cost you. And the reason being is one of the components of options is implied volatility that we briefly spoke of. And basically think of it this way. Let's say that I invited you, or let's say that your job invited you to an office Christmas party 3 years down the road. The reason I use this example is I have no idea what I'm doing 3 years from now. I have no idea what the weather is going to be like 3 years from now. If there's going to be a blizzard and I'm going to be able to drive into the city to make it to my office Christmas party. I have no idea if I'm even going to be working for the same company 3 years from now. The point being is there's so many variables, so many different things that can happen between now and then that to lock yourself into a commitment to attend that party would be somewhat foolish. And when it comes to options, it's almost the same way. Think of yourself as an option seller. Well, as an option seller, I would be more willing to sell an option expiring tomorrow because I know I've got an idea of what's going to happen with the market between today and tomorrow versus between today and 3 years from now or 2 years from now or even 2 months from now. And what that's telling me is that in order for me to accept that risk of the unknown, then I'm going to demand a higher premium when I'm selling options. So the longer term option that you have, the more it's going to cost you. That's also going to lead to a greater risk, greater reward. The more you pay, typically the more ability or there is for a reward. If I'm selling an option for $2, the most I can make on that option is $2. If I'm selling a long-term option for $10, well, the most I can make on that is $10. Granted, I've got a greater reward, but I also have a greater amount of risk as well. Another reason that we use LEAPs, it's an alternative to owning stock. It allows us to diversify. Let's say, we were talking about that online book retailer. If we were to buy 100 shares of that, it would tie up $200,000 of our portfolio. So it's hard to be diversified when you literally have all of your eggs in one basket. So by trading a leap as opposed to 100 shares of stock, it allows that money to be freed up to maybe diversify into different sectors or maybe put on different trades to hedge your portfolio. So that's a little bit of how leaps differ from normal options. The next thing that I want to talk about, again, remember we're building this from the ground up. So the next ladder or the next rung is going to be diagonal spreads. Now, there's different kinds of spreads. There's vertical spreads, horizontal spreads, and then a combination of the two is the diagonal spread. So with the diagonal spread, we're buying the long-term call. We're talking about long diagonals, I should say, long diagonal call spreads. We're buying the longer-term call with the lower strike, and we're selling the shorter-term call with the higher strike. When it comes to our poor man's covered call, we're buying the longer-term call with the lower strike. That's going to be an in-the-money call. And we're going to sell that short-term or that near-term call with the higher strike. That's going to be the out-of-the-money call. So in the examples you see here, that $80 call is going to cost substantially more than the November $90 call. I should say the January 80 costs more than the November 90. So we buy the Jan 80, we sell the the November 90, and that is our diagonal. Now, it's a combination, as I just mentioned, of vertical and horizontal. A vertical spread is simply the same month, the same expiration, but different strikes. A horizontal or a time spread is the same strike, but a different month. And the diagonal combines the two. What we're looking to do is we're looking to get some price appreciation, and that's where we get from the vertical spread. We're also looking to take advantage of that time value erosion, and we get that from the horizontal or the time spread. We talked about how longer-term options are more expensive than shorter-term options. One of the factors that goes into option pricing is time. You've got your extrinsic value, also known as time value, and time obviously is a big component of that. Time decay is also a component of that, also known as theta. Now, for those of you that aren't familiar with theta, theta is the amount by which your option is going to decrease in value on a day-by-day basis, all other things constant. When I say day-by-day, I'm talking about Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. I'm not talking business days. I'm talking days of the week. So every single day, your option is going to lose a little bit of money. Here's a chart that I came up with using the OIC online options calculator. I plugged in some information, share price of 50, and we're using a $50 call at the money, and I put in a 20%, a moderate amount of implied volatility. 365 days out, that call is worth $3.98. It's got about a half a penny worth of theta. And theta is always going to be a negative number. Theta is going to be decreasing from your position, always. So $3.98 with about a half a penny worth of theta. You look about 200 days later, right? 150 days out. That's about 200 days after we put this position on. That theta is still under a penny, and you can see the value of the option drops by, about $1.50 or so, a little bit less. If we do another 75 days beyond that, you can see the option value drops a little more. Theta is now a little bit greater, and so on and so forth. The whole point here is this. Theta is going to eat away at your option very, very slowly in the over the long term, right? The further we go out, the theta is going to eat away at your option very, very little. As we approach expiration, as we lose time for something to happen. Remember, the reason the option was so expensive to begin with is because we had, in this case, 365 days for something to happen with that market. And that's a long time. Anything can happen. When you've got 5 days left, chances are the likelihood or the probability of something happening with that underlying is significantly less. So what it does is that theta is going to eat away at that option price, and then it's going to accelerate. It's going to eat away at a quicker, accelerated pace. You can see at 50 days out, we've got about $0.015 worth of theta. So every day our option is going to decrease by about $0.015. 30 days out, now we're almost at 2 cents. 20 days out, we're at about 2.5 cents a day. 10 days out, 3.5 cents roughly. Until 5 days out, you can see we're losing almost a nickel a day on that option. And on expiration day, that option is going to finish with 0 time value. So that theta is going to decrease. It's going to decay that option, eat away at that option until there's literally no time left. It might be easier to look at it graphically. This I find kind of makes a easier to understand picture. You can see that is, we've got 3 months out roughly. We're fairly flat in the amount of decay, the rate of decay. But 2 months out, it begins to sharpen a little bit, steepen. A month and a half, it's getting a little quicker. A month out, somewhere between 30 and 45 days, that's kind of that sweet spot. That's where theta really starts kicking in. So for option sellers, and the thing about option sellers, they want that option to finish worth 0. If I sell it for $1, I want at expiration that option to be worth 0. I keep that entire dollar in my pocket. So you're going to find a lot of option sellers selling options in that 30 to 45 day range. Option buyers, however, may be looking for a longer term option. The reason being is that theta isn't going to be as prevalent. So that is what we have for theta. And now, just to give myself a little plug here, if you're just familiarizing yourself with the Greeks, or if they're completely Greek to you, as they say, this weekend we are going to be doing a presentation on Saturday, a live in-person presentation in Naperville, just outside of Chicago. So if you are local, you can register. It's a 3-part presentation on Saturday at the NIU Center in Naperville, Illinois. It's also going to be simulcast online, so you can, if you can't make it in person, you can definitely attend online, and like all of our online presentations, they're all recorded. We're going to be talking about the Greeks. We're going to be talking about position management with volatility, implied volatility, and we're going to be talking about trading around earnings season. So myself and 2 other wonderful presenters are going to be joining us, so we're very, very excited about that. Please, when you get a chance, go on the OIC website and register. So that is going to be theta. Our diagonal spread, remember we talked about how it's kind of a combination vertical and time spread. When that near-term option expires, what do? We need to reassess. When you're trading options, unless you're just buying a call outright, pretty much. When you're trading options, you need to manage your position. You need to be vigilant. Options require maintenance. It's not, I know Warren Buffett says when you buy a stock, for example, you put it in the drawer and you forget about it. And that's wonderful when it comes to stocks, especially if it's a low volatility stock. But if it's an option, option traders are active traders. So you're going to be monitoring the options. You're going to be monitoring the stock. You're going to be revising your forecast. You're going to be looking at your objectives on a daily basis. My forecast is I think the stock's going to go to $53. Well, a month out, 30 days out, do I still think we're on track for that share price, or has my forecast changed? Has it revised? And if I've revised my forecast, do I need to revise my trade? Has my objective changed? What about other positions that I have that could positively or negatively affect this trade? So there's all these you can see here potential for modification. We always need to be working and thinking about what are we going to do and how are we going to do it. So again, option traders are active traders, and as that short-term option expires, we're going to need to figure out what to do with that. And we're going to get into a couple different scenarios in just a moment. So let's go ahead, and now that we've built our base, let's get into the poor man's covered call. So the traditional covered call is, as we talked about, you're buying 100 shares of stock and you're selling one near-term call option. You buy 100 shares of stock and you sell that call. With the poor man's covered call, instead of buying 100 shares of stock, we're replacing that stock with a call leap option. We're buying in the money call leap option. We're selling an out of the money near-term call option. What's our market bias? Let's look at a comparison between the two. We're neutral to bullish on both, right? So that doesn't change. That remains the same. Upfront capital, this is a big difference. 100 shares is going to cost you a lot of money. $52 stock, 100 shares is going to cost us $5,200. If we buy a covered call for, say, $10, it's going to cost us $1,000. Big difference in cash there. And with that difference in cash, we can do other things with it. We could put on other trades. We could, as we mentioned, diversify our portfolio by buying options or trading options in another sector. There's a number of things that we can do. So we do have the potential for a substantial upfront cost on the traditional covered call, where we're substantially reduced on the poor man's covered call. Profit's going to be the same. We're limited on both because that short call option is going to require us to sell shares. With the covered call, we have those shares in our pocket. With the poor man's covered call, we don't. So if we do get assigned on that short-term call, we're going to have to do something about it. And again, we need to remain vigilant and keep our eyes open. Downside risk, substantial on the covered call because we are long 100 shares of stock. It's also substantial on the poor man's covered call, but it's less because we've got less money involved. We can only lose what we put into it. Granted, that short call, if we get assigned, that's going to change things a little bit. But the risk on the traditional versus the covered call, it is substantial on both, but it's going to be a little bit less with the poor man's. Assignment risk. Now, this is going to be big. The assignment risk of the traditional covered call, as I mentioned, we certainly have it, and our shares can get called away. Whether or not that's a good or a bad thing depends on the individual investor. With the poor man's covered call, things are completely different. If we get assigned, we don't have those shares to call away, right? We are going to need to get them. So our broker is going to need to lend us those shares, find those shares for us, and let us borrow them. Likely they're going to charge us a fee to do that, so you're going to want to be familiar with your broker's policies on short stock. But here's the kicker. With the poor man's covered call, we won't find out that we got assigned typically until after expiration. We've got expiration on Friday. The short call finishes in the money. We still have that long call. That thing doesn't expire for another 15 months, so that's certainly not going to get exercised. We don't find out until Monday that we've been assigned, and now we've got a short stock position. What we can do, we can obviously exercise the long call to cover that stock position if it makes sense, or we can simply go out and buy 100 shares to cover it. The point being is that we are going to have a short stock position for at least a day. So we need to make sure what our broker's policy is on that, and we need to make sure that we're approved for a short stock position, that we're doing it in an account that allows short stock. There are many retirement accounts that don't allow short stock. And if that's the case, then the poor man's covered call may not be an avenue for you to pursue. Break-even point, again, the traditional covered call, it's going to be the stock minus the premium, whereas the poor man's covered call, it's going to be our long call strike plus what we pay for the option. What we pay for, I should say, the strategy as a whole. So let's go ahead and set up a covered call. Let's look at some of the things that kind of a checklist that we should keep in mind. Now, as I say here, look, these aren't hard and fast rules. What is right for one investor may not be right for you. These are just kind of some guidelines that the investing community looks at when it comes to covered calls. Deltas. The option that we're buying, the long call that we're buying, we looked for a deep in the money option with a delta somewhere between 70 and 80%, or 70 and 80s deltas. I typically say greater than 75. For those of you that aren't familiar with delta, there's several different definitions, one of which is the probability of that option finishing in the money. So the idea here is that we want that long call to have a high delta. We want the likelihood of that finishing in the money to be, very likely. Another thing about the long call, we're using it as stock replacement. So we want that option to move fairly in sync and on pace with the shares of stock. So we want it to behave as closely to stock as we can. Obviously, we can buy a call with a 100 delta, so it's going to move dollar for dollar pretty much with the stock, but it's going to cost a lot of money. So it's going to be a balance of those two things. How much do we want to invest in it, and how much are we going to get out of it in terms of that probability of expiring in the money. So we're looking about 75 deltas. For our near-term call, our short call that we're going to be selling, we want it to be the opposite. We want it to be less than 30 deltas. The idea of that option finishing in the money, that's something we don't want. We want it to finish out of the money. So we're looking for calls with less than 30 deltas roughly. We're also looking at as low volatility. The last thing that we want is to invest in a covered call or a poor man's covered call with a stock that's going to be whipping all over the place. There were some stocks that we were looking at over the last couple of weeks. One had an IPO at 20 in early August, I believe. A couple of weeks ago, it hit 300, and it's been fluctuating back between 100 and roughly 200 ever since. Right now, I think it's maybe 120 or so. The point being is this stock is all over the place, and that is absolutely not what we're looking for when it comes to a poor man's covered call. We want low volatility. Low volatility is going to mean lower premiums, but it also means lower risk. So definitely something to look for. A lot of people would do this on possibly like a blue chip, for example. And then here's another thing that a lot of investors use is they want the extrinsic value of that short call, the time value of that short call to be less than the time value of our long term. And the reason being simply is we want that short-term call to expire worthless. So as time goes on, we want that thing to expire worthless while we still have value on that long call. And the only way to do that is to have the extrinsic value of the short to be greater than the extrinsic of our long term. Now, the thing about these common practices or these rules of thumb, I like to say it's the pink unicorn, right? Sure, it's a wonderful checklist, but you may not be able to find a stock that fits all of these criteria. You know, it's a lot to ask for. So the important thing is that you need to choose a stock that fits your parameters, fits your requirements, fits your market outlook. What I think is irrelevant. It's not my money, it's your money. So definitely make sure that what you're doing, you're comfortable with it, and it fits what you're looking for. So let's go ahead and take a look at an option chain here. Our setup is this. We're neutral to moderately bullish on a soft drink company, but we don't want to tie up a lot of our capital. We want to generate income, and with the shares trading $82, here is our option chain. So neutral to moderately bullish, but we don't want to tie up a lot of income. We don't want to tie up a lot of capital. Looking to generate income sounds like a candidate for a poor man's covered call. So let's look at this option chain, and remember, we've got some requirements here based on that checklist that we just looked at. Our checklist was, we're looking for an out-of-the-money call with deltas of about 75 or more. That puts us in the Jan 2020. Maybe the 75 call or the $70 call, we can look at those two. We're also looking at the near-term call to be out of the money with a delta of roughly 30 or less. That gives us the 85 or the 87.5. Now, we can take a look at the bid and ask on both and see where a fair price is that we could, maybe get filled here. And we're going to go with the 85 call in November versus the 70 call in January. Now, one thing that you're going to see with this January call, for example, look at that market, 1275 at 14.25. You could drive a truck through that thing. And I spent 20 years on the trading floor as a broker, and the one thing I realized is that only suckers pay retail, right? Just because somebody's asking 14.25, that doesn't mean that we're going to pay it. When it comes to strategies like this, you're going to want to enter in a limit order. Typically, you're always going to want to enter a limit order as opposed to a market order. But let's say that we're very good at our jobs, or we're excellent negotiators, and we're going to go ahead and get that long call for 13.5. Now, rather than buy that option, we can simply buy 100 shares of stock outright. We can pay $8,200 up front. Okay. Or we can buy that option, and again, because we're such excellent negotiators, we got it for 13.5. So rather than $8,200 out of pocket, we're paying $1,350. We're saving about 85% on our capital right there, and that difference of almost over $6,800 in cash that we're saving, we can either buy more options. Trade instead of a one lot, we can do 2, 3, 4, what have you, or we can take that money and we can, do something else with it. We can buy puts on our portfolio as protection for, market downturns. Maybe we can buy calls, or we can do something else. The point being, we've got money to do with it what we want. Now, one of the downsides to buying the option versus the stock is we're not stockholders. We are not shareholders. Only shareholders get dividends. So if that stock pays a dividend, we don't get it. We're long the call. We are not long the stock. So that's definitely something to keep in mind. Next, for the sell side, we're going to go ahead and sell that 82.5 call. We were lucky to get a price of $2.20 on that. And one of the things about this is you can see possible to repeat throughout lifelong call. Now, what that's simply telling me is I'm buying a January 2020 call. I've got, about 14 months until that option expires. And this November call is expiring in 45 days. I can do this option every 45 days, every 60 days, what have you. I could keep that long call in position, and I can continue to sell November call, then a January, then a March, what have you. I can keep going and going and going and reducing the my initial investment, right, was $1,350 when I bought that leap call. Well, I can reduce that, every 45 days until it could get to the point where I own that call for free. So it's possible to, simply just create a cycle where we're just selling that option over and over and over again. Rinse and repeat, right? And that's, kind of something that we're looking for. So we're going to execute the trade now. We've got our Jan call that we bought for 13.5. We sold the 82.5 call at 220. What does that come out to? Well, it comes out to $11.30 net. We paid 13.5. We collected 220. Our risk is $1,130 on this. As opposed to, remember, the initial $8,200 investment on the stock minus the short call, we've got $1,100 invested instead of $8,000. Definitely a substantial difference. So remember, we were talking about a smarter use of capital, the thinking man's covered call. This is where that comes in, a more efficient use in capital. And then let's go ahead and break this down as to how it looks. Now, typically what we do is we show graphs and we show tables about how it's going to behave at expiration. The problem is this is a time spread. We've got a short-term expiration, or we've got a short-term expiry and a long-term expiry. So it's kind of hard to exactly say what's going to happen. We can only theorize what might happen if stock finishes. And we're going to be looking at the near term. So 1 week before call expires, stock was 82. Now it's going down to 75. Our option, our leap option, drops in value down to $7.95, and again, that's an estimated value. We plugged in this data in our options calculator. This is what we got. Our short 85 call is now worthless, and our net value, the spread is now worth $795. We lost $335 on the spread. All right. Had we bought the stock was 82. Now it's 75, so we would have lost $700 on the stock if we had done that outright. So we lose less money on that poor man covers call if stock goes the wrong way. Percentage-wise, it's greater simply because we have a smaller investment. So that's always going to be a larger percentage. If things go as we expect, stock goes from 82 to 85 just before that short call expires. Now our long call goes up in value. It's now worth $15.90. Our short call drops down to 60 cents. And again, the reason being it's now at the money. Before it was out of the money, now it's at the money, but we only have a week for something to happen. So it has just a little bit of time value left. Now our spread is worth $1,530, a $400 profit, 35%. If we had just bought the stock outright, we would have made $300. With the poor man's covered call, we would have made $400. And then let's look at it if things go absolutely the wrong way, which definitely can happen. Stock goes from 82 to 90. Our long-term call, well, that's great. You know, it's going the way that we want. It's now worth more money. Our short call, we're down on it, right? But look at that. Our net profit and loss, $400. Well, that looks familiar, right? Because that was the net profit and loss that we had on the, let's go back here. If stock was, sorry about that. If stock was 85, remember, what was our maximum gain? It was 400. If stock is 90, what's our maximum gain? Well, that's going to be 400 as well. So that short-term call, that is going to cap out that maximum profit. Now, that doesn't say that that's all we can make because, you know, just like with the vertical spread, now what happens? Our short-term call is expiring. We still have that long call. What are we going to do? Well, we need to revise. Do we need to revise our forecast, or is our forecast still as it was? Maybe we roll up that strike. If the stock has increased, maybe we roll out that short call from November to January, and maybe we roll up that strike. We see what kind of credit that we can receive when we do that. If stock is down, maybe we roll out to January, but we roll down that strike, generate a little bit more premium. The idea being is depending on what our forecast is, and depending on what we think is going to happen with the market, we may be able to continue with this trade and continuing to generate additional income. You know, these are some decisions that we need to make. What if that short leg just expires? If we let that short leg expire, what are we left with? Well, we're left with a long-term call, and it's simply going to be a naked call. And not a problem if we're bullish on the stock still. What if the market moves against me, right? That's where we talk about modifying our trade, maybe rolling it out. Whatever we want to do, if we're going to extend this trade, right, then we have to do something with that short leg. That short leg is going to expire. And then again, what if we get assigned? We talked about that. You've got a short stock position, and what is that going to mean? Do we exercise our long-term call? And if so, is that financially feasible? Because that long-term call still has a lot of juice left in it, right? The juice being all of that time premium. Do we want to give up all of that juice simply to exercise that option? So all questions that we need to address. All of those questions are going to be based on what we think is going to happen, and it's going to vary from investor to investor. So things that we've talked about today, again, for those of you that are new to this, kind of a checklist. We talked about covered calls as an income-generating strategy. Leaps are the long-term options. Diagonals, we're looking to profit from the difference in price and vol and that theta that we had talked about. And then the poor man's covered call is simply using leaps as that stock replacement. So we've got, looks like we've got some time left for questions. You know, before we do, I just want to, again, for those of you that are new, make sure you visit the website, optionseducation.org. Visit that MyPath assessment that we have to assess your own learning. Here is our contact information.
Thanks, Mark. And ladies and gentlemen, with that, thank you for your time today. For further education, please visit optionseducation.org, the OIC's website, and try the MyPath assessment to gauge your level of understanding of options. Finally, be sure to follow us on social media like our Facebook page, follow us on Twitter to stay current with OIC's latest offerings. And with that, thank you again for attending, and we hope to see you again next time.